Hi everyone, so I want to go over my stop loss strategy, how I choose, how I set and how I adjust my stop losses for my short strangles. And I think it's really important, and this is a video I've never made before. So basically I'm going to show everything from how it looks like, how it looks on the graph, what do I do on interactive brokers, how I find the stop losses, how I set them, and how I actually manually also input the stop losses on the position in interactive brokers. So basically, this is an all about video about stop losses and how I specifically use them for strangles, and I'm sure you will find some value within this video. So to begin with, I just want to go over my dynamic stop losses and basically how they work in theory, and then we'll go over exactly step by step of what I do when I want to open a position, and how I label my stop losses on the graph, and how I know if the position is safe or not safe depending on what stop loss we get. So basically, when I open a position, my max stop loss that I will ever go for will be 50% loss on the credit. So this is the absolute max stop loss that I'm going to go for. The past few trades I went to a stop loss of 40% because it gave me a really good range, and I promise it will make a lot of sense when I talk about my stop loss and what kind of range I get for the stop loss. So for now, if the position is getting to positive 15%, so we're up about 15% of credit, then I move the stop loss to minus 35. Then if I'm up 20%, I move the stop loss to negative 30%, so on and so forth, up until we get to about 40%, where at that point I move my stop loss to positive 10%. So throughout, basically up until 35% profit and beginning 15% profit, I move my stop loss. So there's basically 50 points difference. So 15 plus 35 will be 50, 20 plus negative 30 will be 50, so on and so forth, up until I'm up at 40% of credit. At that point, I move my stop loss to positive 10%. Now, this is basically done to protect us against some massive moves that might happen in the market that are unexpected because of some unexpected news. And from my experience, I've never had a position that went to 40% and then went all the way down to 10% to hit the stop loss, and then went back to 40%. Usually, if the position from that point goes down all the way to 10%, it can go down to to the negatives and even stay there for a while, or even really lose a lot of money. So it's all based on a lot of data, a lot of data, over 9 years of data that I've been working with. And I began with a stop loss of 200%, 150%, and over time I learned how to optimize my trades and how I can have a much better risk reward at stop loss, and how I can actually choose it. Now here at 35% profit, some trades I might move at the stop loss instead of negative 15% to actually 0 to break even. Basically, it's kind of the same reason as I move the stop loss at 40% or at 40% profit, I move the stop loss to 10% profit. It's really unlikely for the position to go all the way down to negative 15 or even to 0 at this stage, because from 35 to 40%, it's a really small jump. It can happen really even in the same day. But usually, I'll keep it at negative 15. But if I see that that something happened to the position, and from plus 35% we are down to like plus 10%, I'll move the stop loss to 0 to break even, just because probably something unexpected has happened and I don't want to lose on the position. So I'm okay with taking a break even on that trade. Now again, to set an estimated stop losses range, I use the position profile on IBKR, which is exactly what we are going to go through right now. So this is my demo account, where I keep all of the trades opened. The ones that I closed, usually I just want to keep them open and see what's going on. So these trades are all closed on the actual account, but here obviously we can see what's going on afterwards. So this is basically post tariffs, but this is not what this video is about. So let's choose silver, 112 days to expiration. Now this is just to give you an example but this is an actual position that I might be looking at depending on what happens with the tariffs. So I'll go with about delta 21 on each side. So I'll go and sell the put side delta 21. And I will do the same thing on the call side. So let's go for delta about 21. We'll sell it. Now I'll go to the position profile. That, now that I have a strangle, and again, I only really trade strangles. Now here's what we get. So we get a P&L graph here, right? So we can go to 30% here, so we can see the entirety of the graph, and we can see how much credit we get. So we'll get $6,600 in credit. So let's say I want my stop loss to be half of that, which is at 50% of credit, which means my stop loss will be at 3,300. So over here, the dotted line is actually represents today's date. So what will happen if the price moves, to any one of those points today, and then the solid line represents what happens at expiration. Now, this does not include changes in volatility, which is obviously a big thing. So this is why these are estimations, but they tend to be really, really accurate from my experience. And obviously, you can go ahead and change the date that you want to be looking at, and it will adjust it based on the theta. But I'm just looking at the default view. So I will go ahead and over here on the right side, this is the P&L of the position, and on the bottom, this is the actual price of the commodity, which is silver at this point. And this is the silver July futures contract. We will be taking a look at it just in one moment. So let's say stop loss is $3,300. So let's go see on the put side. You can see it's negative 3.3K. And on the bottom here on the other axis, we can see that the price should be at around 30 for silver if the position will be down about 3.3K. So at this point, I'll go to my silver July expiration here, and I'll go and I will draw basically a line at 30. So this is approximately, or I guess we can go a bit up to get to 30. Yeah, so this is basically where my stop loss approximately will be on the put side, and this is giving that we open a position right now based on the credit we have on silver on this DTE. So, and let's see where is it on the call side. So $3,300 will be 37.1. So we'll do the same thing at 37.1, which should be right over here. So this is basically my range to my stop losses right now. So these are not the strikes. The strikes are, well, actually on the put side is the strike, but I don't really look at the strikes. I only care about my range to the stop losses. But on the call side, you can see this is, the stop loss is not the strike. So I don't know, maybe actually when I edit this video, you might not be able to see the numbers that I see, but basically our put strike is 30 and our call strike is 39.25. But again, I don't really care about the strikes. I care about my distance to the stop losses. So basically what happens here is, so if the price goes up all the way to 37.1, this is where our stop loss is supposed to get hit, and same thing on the bottom side. Now anything can happen. It all depends on volatility. If volatility is not a factor, then it will be super accurate. Volatility is a factor. But at the same time, these stop losses, they do get wider and wider as time goes. But this is exactly how I go ahead and I check, okay, what is this position that I have? Is it going to be a good stop loss, a bad stop loss? Now, as you can see, it all depends on how much credit you get. So if we would have gotten more credit on this position, so instead of 6,600, it would have been like 7,500. Then obviously our stop loss would have been wider because we can afford a bigger loss. And if the credit is higher, then it means the volatility is higher. So it's just a little thing to kind of think about, right? So this is basically what kind of range I will get for this position. And this is really accurate or extremely accurate from my findings, and I go based on that to make my decisions. Now, a good question will be, okay, where are these lines will be if, for example, the position is up 20, let's say the position is up 25%. It means that my stop loss will be moved to negative 25%. Now, where would my stop losses be on the graph here? Well, this will be just an estimation right now, but usually they stay at the same spot, or they're actually a bit wider. because we maintain the difference of 50% or 50 points, basically. But don't take me on this one. If you're in a position and you're up 25%, go into the position profile of the position, and then you can definitely check it and see, okay, if I'm going to be down right now, negative 15% of credit, let's see where these lines are going to be relative to where they were when I just opened the position. And you'll see it's basically either the same or even a bit wider, so which is obviously better for us. So my philosophy will be to always get a really good range for the stop losses. And how would I know if this is a good range or not? Well, it depends on the graph. So here, for example, ideally, this is not a bad range, but ideally, I would want maybe the price to go down a little bit and to maintain the same range, but just shift it down, right? So then I can see that the price moved within this range since the beginning of September of last year. So it's a good 5-6 months, right? And right now it's just a bit cutting it short here. So I would definitely want price to go down a little bit and then open a position, or I can just open a skewed strangle and then try to move my stops for them to be this way. But then I'm gonna be not as neutral, which is okay if it's not too much. But this, for example, will be a really good range to the stop losses, because the price have been moving within this range for quite a while, like I said. And this is how I know, okay, this is a pretty good stop loss. Now, if we have something like natural gas, right? So I'm not gonna go over and check the exact where the stop losses are for natural gas, but as you can see, it's really directional. So even if we get a massive range, it doesn't matter how big it is, you can see the price was moving within this range for without exiting it for a month maybe, which is definitely not enough. I need at least 3-4 months. So this will be considered a pretty bad range, and I don't want it at all, right? So basically, looking for something where I can say, okay, the price have been moving within this range for a few months. Now, it also depends on the DTE that you choose. This is specifically for about 100 DTE. I want the price to be moving within this range for 3-4 months. And again, the DTE really depends on what's going on in the market. Sometimes, some years or some products are pretty good with 40 DTE or 50 DTE or days to expiration. Right now, silver is definitely going to be much better with 112 days to expiration. Why? Again, just because of the range. Because with 40 DTE or 50 DTE, there's no way to get anything meaningful. It will just be too tight, and you'll be putting yourself at too much risk. But some years, when the price is way tighter, the average true range is way smaller. 40-50 days to expiration just works much better. And right now, that's not the case, which is totally fine. It's not a big deal. Options are just tools that we use to adjust our trading based on what the market is doing, or based on what the commodity is doing. So hopefully this was really clear, and if not, please let me know in the comments. But right now, let's go ahead and see how I actually place these stop losses. So we actually have a silver position over here. So let's go ahead and right click it, and I will press close. Now the window that pops here will be my take profit. So from day, I will change it to GTC, so good until canceled, and I will choose my take profit. So my take profit, let's just throw a number. It doesn't really matter. Just for the mechanics, let's put it at 0.341. Now this is the take profit order is set up. I'm going to click advanced and go to one cancel another. Now I'm going to click contract. I'm going to choose my silver contract. From limit, I'm going to change it to stop. Quantity will be just based on the position. Get from day to GTC. Then I'm going to set up my stop loss, which we can just place at whatever number. At the moment, doesn't really matter. And one important thing is, I'm never actually going to change this from sell to buy, or this. Interactive has a funny way of basically naming the buy and sell orders. So this is why I'm just gonna right click the position and click close, so it will be the default settings for me. And then at this point, that's it. You just press submit, override and transmit, and yeah, there we go. the green one is the active order. This is the limit order, which is the take profit. And the blue one, this order is just being held and monitored. This is the stop loss order. And this is basically it. And then whenever you need to move your stop loss, you just go here, you move it to whatever you need to move it, click update. Stop loss is updated basically, and this is your take profit, which basically doesn't really move. Now, if one of the orders is going to get filled, the other one is automatically will get canceled. So there's no way for you to gonna get filled on both of them if something crazy happens, which is I think really important and really good. So this is basically it. Really, really simple. Hopefully this video made a lot of sense. This is how I choose my stop losses, and basically this is how I move also my stop losses during the position. And I know I got a lot of questions about or requests to make a video like that, so here it is. So hopefully it was a pretty good value, and thank you so much for watching, and I'll catch you in the next one.